Hello everyone. In this video, I will demonstrate the accounting for a forward contract cash flow hedge of a foreign currency transaction. In this example, Alexandria Company on November 1 of year 1 sells merchandise to a foreign customer for 100,000 francs with payment to be received 6 months later on April 30, year 2. So this is an export sale in which Alexandria Company extends credit to the foreign customer. So this customer will not be repaying Alexandria Company until 6 months later. So this gives rise to foreign exchange risk borne by Alexandria Company. And Alexandria Company manages this foreign exchange risk by entering into a 6-month forward contract to sell 100,000 francs at a locked-in exchange rate of 22 cents per franc. So when payment is ultimately received 6 months down the road, Alexandria Company will be selling 100,000 francs to the financial institution counterparty at a rate of 22 cents per franc. So Alexandria Company will be getting $22,000 on April 30 in year 2. So there's an economic cost to entering into the forward contract and extending credit to the foreign customer, because if Alexandria Company had insisted upon immediate payment by the foreign customer on November 1 of year 1, it would have received 100,000 francs at a time when the exchange rate was 23 cents per franc. So upon receipt of the 100,000 francs in November 1, Alexandria Company would have been able to immediately exchange those francs for US dollars at that 23 cent per franc rate, yielding it $23,000. Whereas with the forward contract, Alexandria Company will only get $22,000. So that differential of $1,000 represents an expense, and we call it a discount expense because the franc is trading at a discount in the forward exchange market relative to the spot exchange market. And that discount expense will be recognized over time, over the life of the forward contract. In a transaction situation where a company has a foreign currency denominated asset or liability and also enters into a forward contract, the accounting procedure is to account for the foreign currency transaction and the related forward contract simultaneously but separately. So let's see how we handle that in terms of a journal entry by looking at the first journal entry that needs to be made, which will be on November 1 of year 1. On November 1 of year 1, Alexandria Company records the sale of merchandise and reports it in US dollars because it's a US-based company and its reporting currency is the US dollar. And so the sales of 100,000 francs are translated into US dollars at that spot rate of 23 cents per franc. And the offset to that is the debit to accounts receivable, and we designate it as franc in the parentheses because when that account receivable is collected, it's going to be in the form of foreign currency, namely franc. But for reporting purposes, Alexandria Company will be debiting 23,000 in US dollars. So it's important to remember that all of the entries, the amounts are going to be in US dollars, so translated from francs into US dollars. The forward contract is called an executory contract because no cash changes hands. As a result, no formal entry is made at this time for the forward contract. So that is all that needs to be entered for journal entries for November 1 of year 1. Now let's take a look at the adjusting entries that will need to be made for the end of the fiscal year, December 31st of year 1. At December 31st of year 1, we update the carrying value of the account receivable, and we notice that the spot rate between November 1 and December 31st has declined by 3 cents. So what does this mean? It means that the US dollar has appreciated increased in value against the franc. Whereas in November 1, it took 23 cents to buy 1 franc. As of December 31st, it only takes 20 cents to buy 1 franc. So the US dollar has become more valuable vis-a-vis the franc. Conversely, the franc has depreciated in value against the US dollar. And since the account receivable is denominated in francs, because that's what will be collected by Alexandria Company from the foreign customer when the foreign customer makes payment on April 30 of year 2, the depreciation in the franc reduces the US dollar value of that account receivable, thereby necessitating a credit entry to accounts receivable in the amount of $3,000. So the carrying value of the account receivable has declined in US dollar terms, even though it stayed constant in terms of the foreign currency francs. So that decline in the value of the account receivable in US dollar terms is reflected as a foreign exchange loss on the income statement of Alexandria Company. So there will be a debit to foreign exchange loss in the amount of $3,000. Conversely, the forward contract becomes an asset. Why? Look at the change in the forward rate of the US dollar per unit of foreign currency, the franc. So we see that the rate has declined from 22 cents per franc to 18 cents per franc, a difference of 4 cents over the 2-month time frame. So that makes the forward contract an asset because the 22 cents is the locked-in rate at which the transaction with the financial institution counterparty will take place at April 30. Had Alexandria Company delayed entering into a forward contract to December 31, year 1, it would have been only able to lock in a rate of 18 cents per franc. So that makes the ability of Alexandria Company to sell francs for US dollars to the financial institution counterparty at 22 cents per franc valuable, right? So there's a positive value attached to that forward contract now. So we record the forward contract as an asset, and it's based on the 4-cent differential, which represents the change in the forward rate to April 30, year 2 between November 1, year 1, and December 31. Another thing we have to keep in mind is that the forward contract has to be recorded at present value because the forward contract will be settled on April 30, year 2. That's 4 months from December 31. So the 4,000 nominal value of the forward contract, that is a future value for April 30 of year 2. We need to represent the forward contract as an asset in present value terms. And in this scenario, the annual interest rate is 12%, resulting in a monthly interest rate of 1%. So we can figure out a present value factor for 4 months by taking 1 and dividing by 1.01 raised to the 4th power. And that equates to a present value factor for 4 months of 0.961. So we take the nominal value of the forward contract, that's the future value of $4,000, and we translate that into present value terms by multiplying by 0.961. So the forward contract carrying value as an asset is reported as $3,844, and the credit, which is the offset to that, is to accumulated other comprehensive income for $3,844. And that represents deferment of the gain on the forward contract. Now, what we have here is a cash flow hedge. So it turns out that $844 of the gain on the forward contract will be deferred, and $3,000 of that gain will be reflected in net income. And that meets the objective of the cash flow hedge. So now, with the cash flow hedge, we have a perfect offset of the foreign exchange loss of $3,000 with a gain in the forward contract of $3,000. So those two offset each other. The gain and the loss offset each other on the income statement. And then the $844 that's left over in accumulated other comprehensive income represents a deferred gain. So I mentioned earlier that the opportunity cost for Alexandria Company of entering the forward contract was $1,000. Well, now we have to make an adjusting entry to recognize the accrual of expense. And the accrual period is 2 months, which is 1/3 of the total 6-month period for which the forward contract is in force. So we take the $1,000 and divide it by 3 because 2 months is 1/3 of 6 months. So therefore, Alexandria Company recognizes discount expense via a debit of $333 and an offsetting credit to accumulated other comprehensive income of $333. So what is the impact on pre-tax income for year one? Well, sales in US dollar terms are $23,000. We see the perfect offset of the foreign exchange loss by the gain on the forward contract. So the net gain or loss is 0. And then, of course, there's the discount expense, which I mentioned before. So the net impact on pre-tax income, which goes on the income statement, is $22,667. Okay, now the end of April rolls around and we have to prepare the journal entries for April 30 of year 2. So looking at the spot rate, the change between December 31 year 1 and April 30 year 2, there's a change of 1 cent. So it goes from 20 cents per franc to 19 cents per franc. This reflects further depreciation in the value of the franc vis-a-vis the US dollar. So we're going to have to mark down the value of the account receivable in US dollar terms by another $1,000 because the spot rate has changed by 1 cent per franc, and we multiply that by the notional amount of 100,000 francs to obtain the amount by which the account receivable must be marked down. So the carrying value is marked down by $1,000, and we see that with the credit entry to accounts receivable. And so we have a further foreign exchange loss that is recognized on the income statement as a debit, $1,000. Now we have to adjust the carrying value of the forward contract. And so we compare the forward rate from November 1 year 1 to the spot rate at April 30 year 2. And that's a difference of 3 cents per franc. So we need to adjust the carrying value of the forward contract so that it ends up being $3,000. So previously we had recorded an asset for the forward contract of $3,844, reflecting increase in the value of the forward contract. Now there's been a retrenchment of 1 cent. So now we have to mark down the value of the forward contract to the correct amount. So previously, the carrying value of the forward contract as an asset was $3,844. Now we've got to get that carrying value down to $3,000. That results in a credit entry of $844 for the forward contract and a debit to accumulated other comprehensive income of $844. So now the forward contract carrying value is at its proper amount. Then we have the objective of cash flow hedge accounting, where we have the perfect offset to the foreign exchange loss of $1,000 with an offsetting gain on the forward contract of $1,000 as a credit and a debit to accumulated other comprehensive income for $1,000. And remember, the total discount expense was $1,000, and we had made an adjusting entry at December 31, year 1, of $333 for discount expense. Now we recognize the remaining amount of discount expense so that we get to total discount expense recognized with $1,000. We accomplish that with a debit to discount expense for $667. And there's an offset credit to accumulated other comprehensive income for $667. So now Alexandria Company receives payment from the foreign customer in francs. So Alexandria Company receives now 100,000 francs. It has collected on the accounts receivable, so now we can close out the accounts receivable relating to this transaction. That foreign currency of 100,000 francs is worth $19,000 based on the spot rate as of April 30, year 2. Alexandria Company will take the 100,000 francs that it has collected from the foreign customer and will now deliver them to the financial institution counterparty, in other words, the counterparty to the forward contract, and will receive in exchange $22,000 in cash, in US dollars. So the accounting to reflect this is a debit to cash for $22,000. There's a credit to foreign currency reflecting the delivery of the foreign currency collected from the foreign customer. It's delivered to the financial institution counterparty, and the forward contract is now closed out. So everything balances out. What's the impact on pre-tax income for year 2? Well, again, we have the perfect offset between the foreign exchange loss and the gain on the forward contract. So there is no net gain or loss. The remaining discount expense of $667 was recorded in year 2. So the net increase in retained earnings, ignoring tax effects over 2 years, is $22,000, which is $22,667 minus $667. So the company in question, Alexandria Company, successfully managed its foreign exchange risk exposure by entering into the forward contract.